Welcome to Sale of Property, Taxes on Gains and Losses. This is lecture 4 for my business income tax class. And in this video, we'll be talking about what happens when you sell stuff. So we're going to cover asset sales by first going over some basic concepts. Then we'll look at the tax forms that will be used to report the sales, just an overview. And then we'll look at how the gain or loss is actually going to be taxed by looking at first holding period and the 3 asset classifications. There's ordinary income property, capital gain property, and Section 1231 property. These are our 3 main categories. From there, we'll dive into how to determine which asset category applies. We'll then look at how taxes are applied to gains and losses under each category and some additional subcategories. And then we'll actually take a look at the forms again and apply some basic scenarios. Lastly, we'll look at some special asset sales and tax issues related to sales of assets. And that will include taking a look at the net investment income tax, calculating stock basis for sales of stocks, and calculating basis for gain or loss on sale of property that you get from a gift. Let's jump in. Stuff that you own is called property or assets. You legally own something. If you use this in a business, then it means that you're using it in a business to make money. So sale of an asset equals a gain or loss. And our real question is, how is it taxed? Because remember, tax rules, whenever you get money, it's taxable. That's the default. We've got to take a closer look at the rules. So amount realized, that means your sale price, but it can include a lot more than what people tend to call a sale price. So we, of course, have a special tax term for it. Minus the adjusted basis of the property, which is what the owner's basis is in that property. We'll talk more about that. And that equals a realized gain or loss if my investment in the property is actually greater than what I sold it for. And we'll take a closer look at that adjusted basis. So cost basis is what you paid for an asset plus other costs for getting it ready for its intended use to you. And then we subtract depreciation taken on tax returns, and that equals adjusted basis. And of course, we can't take depreciation on anything. We have to follow the rules. Sale of asset example. So we must never assume. A lot of times people want to say, I got a loss, no worries. $10,000 sale price minus $6,000 adjusted basis equals a $4,000 realized gain. We'll be talking more about that, what that means. We got to that $6,000 adjusted basis through $20,000 cost basis minus $14,000 of depreciation taken over the years, which equals a $6,000 adjusted basis. That amount goes right here. So now let's go into more detail about this cost basis. So when you get an asset by purchasing it, your basis is essentially the cost of the asset, what you pay for it. However, if there are other things involved, if someone provides you services as part of your deal, or gives you more property, or you give up property, if you're receiving property in addition to cash, the fair market value of that property is included in the sale price, along with any liabilities that the buyer may assume on your behalf. And so when you think about basis is the amount that you've assigned to an asset based on the rules. And it also includes all the costs that you spend to get the asset ready for its intended purpose or use. Now, we don't always purchase assets. We could inherit an asset. And in that case, the cost basis is based on the fair market value of the property at the date of death. Or if they have an executor of estate who uses an alternative valuation date within 6 months, In either case, the purpose of this, although sometimes 6 months can make a big difference on the fair market value, but with the fair market value, the idea is if my uncle buys a building 30 years ago for $10,000 and it's now worth $1.5 million, and I inherit it and I sold it, and if my basis was his basis, then if I sold it, I'd have a tax on nearly $1.5 million. However, this rule for basis really goes against tax principle, which is the ability to pay, because the person who sells a $1.5 million asset actually has the cash to pay taxes on that asset. So more on cost basis. We could get an asset from a spouse or in a divorce settlement. And in that case, the adjusted basis would be the ex-spouse or spouses the day before they transferred that asset. Now, what if we get an asset through a gift? There's quite a calculation which we'll go through later, but we're going to look at the fair market value on the date of the gift, and if it's less than the adjusted basis of the giver versus if it's equal to or more than the adjusted basis of the giver, and what the sale price is. And we have to look at all those things to decide what the basis is. So some general concepts about selling property, we really want to look at, okay, well, how is that gain or loss treated for taxes? Now, realized gain, that means the amount that's calculated. When we have a recognized gain, that's the taxable amount of the amount calculated. So it could be the same or it could be less or more. The first layer of the sale of property is really looking at how the asset is used, not what it is, not if it's a house versus a car. Now, some of that will come into play in subcategories, which all are sections. We'll talk about all these different sections of the tax code rules. And the forms that we'll be getting into are Form 4797, Form 8949, and Schedule D. So for your cheat sheet, use this information. This is summarizing what we just covered, and we'll have more of these throughout the video. So an example on basis. You're a tax pro, and your client, Jimbo, tells you that he sold land in Kauai for $75,000. The buyer also assumed a $10,000 loan that Jimbo still owed, but he tells you this doesn't count, it wasn't really on the land, blah, blah, blah. Well, Jimbo's adjusted basis is $64,000. What do you tell him? What is the gain or loss? Well, for our amount realized, it doesn't matter what the liability was on. The fact that the buyer took on that liability, that's the same thing as him giving us cash and us paying the liability. So amount realized, the sale price is $85 minus our adjusted basis is a $21,000 gain. So we'll run through those forms we just went over. Form 4797, sale of business property. And you can see what we've been talking about is basically here, date acquired, date sold, sale price, depreciation, cost or other basis, and gain or loss. So this part one section, there's different parts. This is for assets held more than a year, business property. This is the bottom of that form. We'll be looking at these forms in more detail. This is page 2. On this page, the properties are listed this way. And we'll be talking about what goes where. You see all of these section numbers. These are different rules and subcategories. We'll be talking about these categories next, and then looking at how to fill out the forms. Form 8949 is sale and other disposition of capital assets, a term you'll be familiar with by the end. And of course, you see all this information here. This form is primarily used for stocks, bonds, and other things. Schedule D is a summary form, so a lot of stuff from other places is summarized here for investment property. So, how is the gain or loss taxed? We're going to base this on two primary things. Number one is the amount of time that someone owns an asset. And number two, the tax asset classification. This is our first level of classification, and it's based on how we use the assets, not based on if it's a car or a house or that sort of thing. So number one, our time frame called a holding period. It's either short term, which means that we owned the asset for less than a year, or it's long term, which means that we own the asset for more than a year. So this time period is specific, not general. It begins the day after the property was purchased, and it ends on the day that it's sold. So you get no credit for the day of purchase, and you get a full day for the day that it's sold. Now, if the property or asset was acquired another way, like we talked about, then there's more rules based on which basis applies. However, they follow the general concept as well. So number two, we have our time period, and number two is our asset classification. This is our broad classification. Number one is income, ordinary income property. Number two is capital asset property, which is also called Section 1221 property, but it's more often referred to as capital assets. And number three, trade or business property, which is most often called Section 1231 property. So gains and losses in certain scenarios may fall into another category. So now we're going to look at these three asset categories and what falls under each. How do we put an asset sale into a category? So ordinary income property is probably our less used, simpler category. It's a catch-all defined as everything except a capital asset, which we'll talk about in category number two. In addition to that, this category includes inventory and accounts receivable, which actually are business assets, but they're generally not capitalized on the balance sheet like other types of assets because they're short term. Inventory, right, is stuff that we either create or buy to sell in our normal course of business to customers. So we are deducting that amount as we're recording income. Receivables includes accounts receivable. So we record accounts receivable when we record revenue, but a customer hasn't paid us yet, so they owe us that money. And a note receivable is we're lending money for the purpose of getting interest or supporting whoever we're lending money to, but these are both receivables. So these things are assets, they're things we own. Now this also includes copyrights and literary, music, and artistic compositions in the hands of the creator. Once the creator sells those things, they become a different type. Our second type, capital asset, Section 1221, and there's 4 parts to this definition. Now, the main thing you need to know for capital assets used for personal use or investment use. Some examples: investments in stocks and bonds. That's a huge one. A home owned by a taxpayer. Timber grown on home property or investment property. That's a very specific category in tax code. Household furnishings are personal. A car for driving, personal use. A coin or stamp collections, gems and jewelry, could be either personal use or investment based on why they're holding it. Gold, silver, and other metals, typically investment. So more on this definition. The Internal Revenue Code defines a capital asset also by exception, just like our first category, includes all assets held by the taxpayer except ordinary income property, our first definition. Property used in a trade or business, that's going to be our third definition. Real property used in a trade or business, also our third definition. any commodities, derivatives, financial instruments held by a dealer. The second one is similar as well with hedging transactions. We won't get into those. Those are very specific to the financial market industry. Supplies used or consumed in the ordinary course of a trade or business. So remember, this is not including supplies. Supplies are typically not capitalized on the balance sheet. Instead, we just expense it because it's considered de minimis typically. So artistic works, this was the last one we said, artistic works owned by the creator. That is ordinary income property, number one. When they sell it, the purchaser, it becomes a capital asset. And then other specifics within music compositions and copyrights. So our third category, trade or business use property. So assets that we are using in our business to facilitate our business, generate income, are Section 1231 property. They can be depreciable or not depreciable, and they must be used for more than 1 year in the business. They must be long term. Short term actually will go back to our number one category and become ordinary income property. Now, land used in a business is specifically 1231 property. It's not depreciable, but it is an asset used in the business, often for more than 1 year. Now, this does not include otherwise assigned business assets like inventory, notes receivable, accounts receivable from our first category. Examples of long-term held could be business equipment, business buildings, and land, but it must be used in or for the business, not held as an investment. Otherwise, then it'll become a capital asset. Now, specifically included are some items there from farming and various specific rules. So since long-term is part of our core definition of Section 1231 property, that short-term business assets become ordinary income property, that number one category. And the way that this is often stated